So Edmonton, I get asked regularly what's happening in the real estate market and what are the trends that we're going to see. And so what I'm going to do in this quick few-minute video is just go over some of the outside influences that I think are going to affect the Edmonton housing price. And if you would like to see what's going on in the Edmonton real estate market for May 2022, you can just click the link at the end or visit my YouTube channel, Facebook page, and it will all be there. My name is Jason Beatty. I'm your realtor with eXp Realty because your move matters. So let's get into it. Oh, and do me a favor, like and subscribe if you value this information and if you would like it to regularly appear as we post the information. So we're going to start off with what has happened this week. Most of you are going to know that the Bank of Canada raised its rate. So on the 1st, so we see in the global news, Bank of Canada hikes key interest rate 50 basis points for the second time in a row. And so basically, the Bank of Canada raises its benchmark interest rate to 1.5% on Wednesday, making a second straight increase of half a percentage point. Now, I was kind of hoping that they would stretch it to 75 basis points or more, only because what I'm seeing happening right now, it looks like, have you ever seen a kid drop a marble, say, or a little ball on a driveway that's sloped downwards? As they start to walk towards it and that ball's rolling away, by the time they bend over to pick up the ball is already gone. I see that with what's happening in inflation. We are only taking action up to the point where that ball is. So by the time we make the announcement, the ball or inflation has already gone past where we are. And so I think if Bank of Canada keeps making these minor, they're pretty major adjustments, because we haven't seen an adjustment like this in 25 years. And I'll explain a little bit more as we get going. But I think we need to see greater adjustments to get out in front of it. And so we see the 50-point move was widely expected. Nobody was surprised by this, okay? And we saw the central bank, most predicted that the central bank would raise rates. This is for the third time this year. So what they're trying to do is tap down inflation. Now, Wednesday's increase marks the first time the Bank of Canada has hiked rates 50 basis points in back-to-back decisions in the last 25 years, okay? So that's pretty massive. Now, with the economy in excess demand and inflation persisting well above target and expected to move higher in the near term, the Governing Council continues to judge the interest rates will need to rise further. Okay, and so that came from the Bank of Canada in their statement. The pace of the further increases in the policy rate will be guided by the bank's ongoing assessment of the economy and inflation, and the Governing Council is prepared to act more forcefully if needed to meet its commitment to achieving the 2% inflation rate. So I think they're kind of hinting that they will start to jump to 75 basis points or more if they need it. Unfortunately, this is starting to feel a little political, where they are making decisions based on keeping everybody happy. But, that is just my 2 cents on that. What that may mean is, like the kid with the ball rolling down the driveway, it's going to take a while before they realize, no, I got to step out in front of it, put my foot down, stop that ball, and then we'll take control. And now, as we head on, I'm going to talk about what we're looking coming. This also was in Global, and it was dated June 2nd, so basically just yesterday. Bank of Canada is open to raising key interest rates past 3%. We're at 1.5% right now, and so that's what the Deputy Governor has said. So the Deputy Governor of the Bank of Canada says it may need to raise its key interest rates to 3% or beyond to ensure inflation doesn't settle in for the long haul. So you know what? They're already acknowledging that if they let this ball keep rolling, there's a good chance that they're going to have to jump out in front. We're at 1.5%. They're now foreshadowing that they could go to 3% or beyond. It almost feels like they're softening the blow. So they warned us yesterday on the 1st that they may need to get more aggressive than the half a point. And now, a day later, they're saying, you know what, we may have to go well over 3%. So we're scared that this inflation becomes entrenched, Paul Boudry told reporters Thursday afternoon. In an early speech to the Gatineau Chamber of Commerce, he said the likelihood of ever higher consumer prices on the horizon means the central bank will consider pushing its policy rate at least to the top ends of its neutral range, between 2 and 3%, which neither spurs nor hampers growth. Now, we are seeing a lot of outside influences that are affecting this. The issues that Ukraine is having with Russia. That's making it very difficult to be able to produce grain. We've seen grain prices go from $7 to $14, I believe, is what they're looking at. And so that's also creating a global shortage. When this grain was expected to come to market is, what are we looking at? 6 months from now. And so what's going to happen at that point if two of the largest producers, Russia and Ukraine, don't have the ability to be able to get grain to market? Russia because we're not allowing them, and Ukraine because they weren't able to grow any. So that's something to think about as well, because that's just one little segment of where we're going to see this inflation go. We're seeing inflation, I think, at 6% in April, and I'm concerned, based on what I'm seeing, that it may even be higher than that in the next go round. So let's see how that goes. We see that price pressures are broadening and inflation is much higher than we expected and likely to go higher still before easing. So Baudry is actually expecting the same thing. So if we saw 6% in April, where are we going to be 7 or 8% come the next release? So this raises the likelihood that we may need to raise the policy rate to the top end or above the neutral range to bring demand and supply into balance and keep inflation expectations well anchored. So now most people are saying, okay, yeah, you know what, but when the bank raises their key rate, it doesn't directly affect the mortgage rate. And that's correct. It may affect the variable rate, doesn't affect the fixed. But there's an interesting section here at the bottom that does talk about, sorry, I'm just going to scroll down, and we're just going to jump to that. Okay, so there's big sections in this that does speak to housing prices decline in certain segments. And if you'd like to see what has happened in Edmonton, I do have the May market report, which actually is June. So it comes out in June for May. That has just been done as well. So you're going to find that on my YouTube channel. You're going to find the links below in the chat or in the tile at the end. And please like and subscribe. So now as we go on, something that was interesting he noted is we haven't managed to keep inflation at our target. So it's appropriate that people are asking us questions, okay? So he's acknowledging out front, look, we haven't been able to get in front of this. We've kind of been wrong every step of the way, so it's okay for you to ask. And that's another reason why I believe that they may be foreshadowing, because they're acknowledging, hold it, they originally said it was transitory, the inflation wasn't going to set in. Now that we're seeing it setting in and increasing, they're going, holy crap, we better get in front of this. Now, the part that's going to affect our long-term mortgage rates, our fixed 5-year, for example, is this section here. Now, the bank expects its holding of Canadian government bonds, which sat at $440 billion at the end of last year, to fall to $280 billion by the end of 2023. That's a 35% drop over 2 years. Basically, what happens is that Canada was buying a bunch of these bonds to be able to keep those long-term rates down. What they announced in April was that they no longer have a desire to keep buying these bonds, which means that our interest in these bonds, the Canadian government interest in them, is going to decline because they stop buying as the bonds become due. They're just not going to buy new ones. So we will see it continue to decline. So if we see a 35% decline in the bonds by the end of 2023, that is going to suggest that our 5-year rates will continue to go up and should continue for a good period of time. So what's going to happen in interest rates? My expectation is they're going up. For every percent they go up, your buying power drops by 10%. If you qualify for a $500,000 home today, if the interest rates are, say, 1% higher by next spring, you're only going to qualify for a home that's $450,000. Okay, so it's really important to understand and weigh. I run into a number of individuals that believe that you need 20% down to be able to buy a home. You don't. You can do it with 5% down. Yes, there is an insurance premium that you pay on it. It is fairly substantial when you look at the total percentage of your investment. But as we think about it, the ability to buy today versus the ability to buy tomorrow, a year from now could mean that you afford 10% less home and your mortgage payments will be higher because the interest rates, based on what we see, if you agree with me that all the signs are saying that, rates are going up and going to continue to grow up, go up somewhat drastically, then that means your mortgage payments are going to increase drastically. So something to think about with that. Now, the other thing that I want you to think about that is going to have some interesting effect on pricing in the future, pricing of houses. And I don't know how far in the future, because there's so many different factors, but I just want you to be aware of this. Fortune wrote on May 27th, lumber bubble 2.0 just burst. Here's what to expect. Here's when to expect the best deals. So they write that since the beginning of the pandemic, lumber prices have been more volatile than at almost any other time in history, leading to some major headaches for home builders and buyers. In fact, the volatility swings in lumber over the past year alone has pushed the average price of a new single home higher. Now, this is an American dollar. I'm not going to talk about that because we don't have that right here readily available for you. So over the past 3 months, though, however, with interest rates rising and the housing market cooling, demand for lumber is falling, and so are prices. Lumber is one of the major exports that we have in Canada, and so we saw lumber prices increasing in the States. We were exporting our supply to the States, which also pushed lumber prices up in Canada. So it's important to understand that even though this is an American article and it talks directly to what's happening in the States, it's really important to understand that lumber is one of our major exports. Now, over the, where were we here? Lumber futures are down over 50% since this year's January peak at $1,329 per 1,000 board feet. It came down to $651 per 1,000 board feet on Wednesday. So that's a massive discount. That's over half that it's dropped. So what they're saying is that when you're buying futures, you're expecting the cost of lumber to be down at this price. Now, but before we jump into where the lumber prices are headed, it's important to look back over the past 2 years and see how the market got to where it is. So there's been two major spikes in lumber prices since 2020. The first began when COVID-19 lockdowns caused the market suppliers to anticipate the slowdown in demand, leading sawmills to furlough staff and reduce production. By April 2020, though, U.S. wood production had fallen 15% from the 2019 levels. So they expected building of houses to decline. So they basically were shutting down mills. The move by the mills was a logical one at the time, but record fiscal and monetary stimulus, a home renovation boom, and historically low mortgage rates ended up spurring demand for home building and consequently for lumber. So what they did is, because of all the money that was spent and given away in the States and Canada to make sure that, people during these lockdowns had the ability to survive, it also meant a lot of the individuals that had money also spent it. And so we saw people that were doing home renovations during this time, or a lot of landscaping going on during times that maybe they would have spent that money over the winter time in warm, sunny locations. In the summertime, maybe they would have been traveling throughout their own country, but they weren't able to travel, so they didn't. So all of a sudden they had a budget that they had allocated for that and said, look, if I'm going to hang out at home, I may as well make my yard or my house the best place possible. And so that's where we saw a lot of this money being spent. Now, falling supply and rising demand led lumber prices to soar over 300% from pre-pandemic levels through May 2020. So from 2020 to the first half of 2021, it really was an issue of production at the mill. Okay. There was just enough sawmill output, not enough wood product output to meet demand. So of course, a historic rise wasn't sustainable. Record lumber prices crushed builders and remodelers' budgets, and eventually the lumber bubble popped and buyers began to balk it and seek alternatives. So the culprit of this correction was the demand side, is what the CEO of Deacon Lumber had said. So in September 2021, home builders saw the full brunt of rising lumber prices and completely hit the brakes. So all of a sudden the builders have stopped building spec homes. Now all of a sudden what's happening is we're starting to see lumber prices come down again. As we can see, there was that spike. We went as high as $1,600 per 1,000 board feet. Then it dropped down. We went back up in January, and now we're back on our way down. Now, lumber price relief proven to be short-lived, however. Supply chain woes exasperated by high labor costs and flooding in lumber-producing British Columbia kicked off a second wave of price increases through March on this year. So if you do remember, earlier in the year, we did have the flooding in BC around Abbotsford. And so this really created a lot of havoc in the lumber industry as well, which also jarred that spike. So I would say that this is the latest run. I would say that this latest run has been largely a crisis of shipping and logistics. You had this kind of 1, 2, 3 punch of flooding in BC, a COVID wave, and then to top that off, we're hit with a seasonally slow period of shipping. That's the other thing, is now with supply chain issues, we have wood not getting there on time. Every aspect of home building is not getting there on time or not available. Now, what's going to happen this year with forest fires? We will see how dry this is. But anyway, let's go. Where does this lumber go from here? With mortgage rates soaring and home renovation boom fading, Jalbert told Fortune that lumber's extreme boom and bust cycle are likely over, barring another unforeseen war or economic crisis. I think the worst of the volatility is behind us. That's the biggest thing, Jalbert says, adding that there's a lot of concern about what lumber demand will look like in the second half of the year as recession predictions spread. And he's not the only one predicting the end of this lumber's wild ride. It's our belief that we are past peak demand and this commodity bull wave is over. Kyle Little, the chief operating officer at Sherwood Lumber, told Fortune via email. It's now moving into the next cycle. Little poses the question, what does the price of lumber or even housing do in an environment where demand is flat to down and supply is slowly rising? The obvious answer, price decline. It all comes back to basic economy 101, supply and demand, he says. When it comes down to it, it's just sometimes, when it comes down to it, it's just sometimes in the short term, the supply-demand balance doesn't correct because the supply side just takes a lot of time to respond. So what it's saying is, you know what, it hasn't been an instantaneous correction. We are seeing future prices of lumber coming down, but it may take a little bit of time to get there. In Canada, depending on the market that you're in, we're going to see some differences going on. We know that in Alberta, we have led the way in net migration from province to province moving. This is the first time since 2015. And so far, 2022 has been strong for that. That has put pricing up. We have seen many Ontario people coming to town, buying homes sight unseen, and buying without conditions. And so there was a lot of that craziness. The market has slowed down a little, but I encourage you to see May's report. If you have any questions, feel free to reach out. You can message me or comment below. Please like, share, and follow these videos if you see value. And remember, my name is Jason Beatty. I'm your realtor with eXp Realty, because your move matters.